Welcome to the first video of the course module dedicated to the formulation of corporate financial strategy. In this module, we will be discussing issues related to the financing of companies and investment projects, such as the optimization of capital structure and financing costs. We will also explain the need for a sound financial risk management framework in an organization. In this video, we will focus on how the financial performance of an organization may be assessed using ratios as well as their trend over time. As you will surely appreciate, the evaluation of a company's financial performance is crucial not only from the perspective of formulating an appropriate financial strategy, but it is an essential part of financial management in general. Ratios relating to an organization's profitability, liquidity, gearing and market value, as well as their evolution over time, can help explain changes in the way the company is perceived by investors. They may also signal that the financial strategy adopted requires adjusting. In just a few moments, we will review the ratios which are most commonly used in financial analysis and illustrate their computation and interpretation using a sample balance sheet and profit and loss account. The first area of financial performance which we will focus on is profitability. Among the most commonly applied profitability ratios is the return on capital employed, usually referred to as ROCE. It is typically computed as the profit before interest and taxes, or EBIT, divided by the capital employed being the sum of equity and long-term financing. An after-tax version of ROCE is also used where the tax shield effect is included in profit before interest before dividing it by the capital employed. Let's now calculate the ROCE using the sample financial statements. In year 1, the ROCE before tax is calculated as the profit before interest of €500 divided by the sum of bonds issued of €1,000 and total equity, which amounts to €2,330. Accordingly, the year 1 pre-tax ROCE comes in at 15%. When the same calculation is performed using year 2 numbers, the result is 17%. The after-tax version of ROCE for year 1 is calculated as the profit before interest of €500 multiplied by 1 minus the corporate tax rate of 30%, which is subsequently also divided by the capital employed, producing a result of roughly 11%. After-tax ROCE computed in respect of year 2 amounts to 12%. Return on capital employed shows a company's efficiency in using capital, and as you can see, in the analyzed case, this efficiency improved year on year when viewed from both a pre-tax and after-tax perspective. Another profitability ratio which is commonly used to assess the performance of a company is the operating profit margin, measuring the proportion of revenue left after covering the costs directly associated with generating this revenue. So, in year 1 of the analyzed case, the operating profit margin is computed by taking the gross profit of €1,900 and dividing this number by the total sales of €5,400, which gives a result of 35%. In year 2, performing a similar computation reveals an operating profit margin of 40%. The interpretation of these results is that the company made 35 cents in profit before fixed costs, interest and taxes on every euro of sales. This amount grew by 5 cents over the course of the second year. Knowing that the profitability of the company has been improving, let's now inspect how its liquidity position changed over the same period. To do this, we will concentrate on ratios relating to working capital management. The first ratio which we will be analyzing is referred to as debtor days, or the receivables collection period. It shows the average number of days which the company needs to wait to receive cash from its trade receivables, and is calculated by taking trade receivables from the balance sheet, dividing them by the revenue achieved from sales on credit terms, and multiplying the result by 365 days. In the analyzed example, it is not apparent what portion of the revenue comes from sales on credit, so we will assume that the entire revenue generated was subject to deferred payment terms. Accordingly, to calculate debtor days for year 1, we divide the balance of receivables amounting to €350 by revenue of €5,400 and multiply the result by 365, which gives 23.7 days. When we compute the same ratio in respect of year 2, we receive a result of 16.6 days, which means that in the second year the company was able to shorten the average time needed to collect cash from invoices issued. Let's now see if the terms of payment made to suppliers are also showing signs of improvement. To assess this, we need to calculate a metric known as creditor days, which is also referred to as the payables payment period. Creditor days show the average period after which the company pays its suppliers. So the higher or longer this ratio is, the more financing the company receives from its suppliers. Creditor days are calculated by taking the balance of payables, dividing it by the purchases made, and multiplying the result by 365. Using the cost of sales as a proxy for the amount of purchases, year 1 creditor days are calculated as payables of €280 divided by €3,500 from cost of sales and multiplied by 365 days, which gives 29.2 days. Creditor days computed in respect of the second year equal 38.7 days, which means that year on year the company managed to obtain significantly more favorable payment conditions in its relations with suppliers. However, similar increases may also be a sign that the company is falling back on its payment obligations due to a liquidity crunch. Finally, we can calculate the inventory holding period, which shows the average number of days for which the company maintains items of inventory, raw materials, work in progress, as well as finished products or goods held for resale. This measure is obtained by taking the balance of inventories, dividing it by the cost of sales, and once again multiplying the result by 365. Performing this computation reveals a drop in the inventory holding period from 83.4 days in year 1 to 77.4 days in year 2, which represents a significant improvement. All three of the liquidity measures which we just discussed may be combined into one indicator known as the cash operating cycle. This metric shows the length of time which on average elapses between the payment for inventories acquired and the receipt of cash for goods and services sold. It is calculated by adding debtor days to the inventory holding period and deducting the number of creditor days. In the analyzed case, the cash operating cycle shortened from almost 78 days in year 1 to 55.3 days in year 2, which suggests a substantial improvement in the company's liquidity position. The third group of ratios typically used to analyze financial performance relates to gearing, in other words, the level of the company's indebtedness. If gearing is too high, then the company may find it difficult to service its debts, as it may simply generate insufficient cash to repay the interest on loans and bonds issued. Gearing may be assessed from the perspective of the balance sheet as well as the profit and loss account. The balance sheet gearing ratio is calculated as an entity's debt divided by its equity, or alternatively as the proportion of debt in the total capital employed, that is the sum of debt and equity. In the analyzed example, in year 1, the first type of balance sheet gearing ratio amounts to 43%, that is the €1,000 of debt divided by €2,330 of equity, and the second type amounts to 30%, which is derived by taking the same €1,000 of debt and dividing it by the overall level of capital employed, that is €3,330. In year 2, the ratios come in at 35% and 26% respectively, showing a decline in the level of balance sheet gearing between the years. Let us compute the profit and loss gearing ratio, which will allow us to assess whether the company's profits are sufficient to cover the burden created by interest payments. In order to do this, we need to calculate the so-called interest cover, being the ratio of profit before tax to interest for the year. So, for year 1, we divide the profit before tax figure of €500 by interest of €110 to reveal a result of 4.55. The same ratio computed in respect of the second year comes in at 7.5, which is a sign that the company's potential to service its interest payments increased over the period analyzed. So far, we have been discussing ratios which relate to the company's reported financial statements. In all of the areas which we have investigated, that is profitability, liquidity and gearing, they have shown signs of improvement on a year-on-year basis. This suggests that the company's perception by investors should also be improving. In order to verify this proposition, we may analyze some ratios of a stock market nature. Please note that these ratios can only be calculated for entities whose shares are listed on a stock exchange. The stock market ratios which are most often used comprise the price-to-earnings ratio, dividend cover and dividend yield. The first of these, generally referred to as the P/E ratio, shows the relation between a company's share price and its earnings per share. Dividend cover is the ratio of an entity's earnings per share and its dividend per share and shows the portion of earnings that are paid out in the form of dividends. And finally, dividend yield represents the relationship between dividend per share and the share price. In the example analyzed, there is no information concerning dividend payments. In fact, when we compare the balances of retained earnings as reported at the end of years 1 and 2, we note that the entire profit booked in year 1 has been retained by the company, implying that no dividends were paid out to shareholders. Consequently, we are unable to calculate neither the dividend cover nor the dividend yield. We may, however, analyze the P/E ratio. To do so, we need information on the number of shares, which equals 1,000, and the relevant share prices. Let's assume that these stood at €1.40 and €2.25 at the end of year 1 and year 2 respectively. So the P/E ratio for the first year is computed by taking the share price of €1.4 and dividing it by the profit achieved for the year on a per share basis. So that's €273 divided by 1,000 shares, which yields a result of €5.13. The same ratio computed in respect of year 2 comes in at €6.18. Once again, this represents an improvement and is a reflection of increased shareholder confidence in the company. As you can see, ratio analysis allows for a relatively easy and quick assessment of the financial performance of a business. Additional insights are gained when trends in ratios are analyzed across periods. Ratio analysis can be used by both shareholders and market analysts to assess the performance of entities listed on the stock market, but it is also applied by companies internally for the purpose of formulating and assessing financial strategies.